the relationship that we built with Mitsubishi, it is now very evident that the growth prospects, not just in our aftermarket and automotive business, but in a whole range of vertical markets where Mitsubishi Electric Co. are very strong, we're beginning to explore in some detail the business cases for moving more rapidly into these adjacent markets.
Hello, you're watching Proactive Seeing Machines now with this full year 2025 trading update today. Joining me to provide more color on the results are CEO Paul McGlone and CFO Martin Ive. Paul, Martin, very good to speak with you. Paul, I'll start with you. Give us your view of the results, please.
Look, we're very pleased with this set of results. The top line is growing as we indicated it would in April. What we've seen is a really strong rebound in our automotive royalties. We've seen our Guardian Gen 3 product start to move. We are approaching production capacity, and we moved 2,500 units at the kind of right at the end of the last quarter. So that sends a positive tone for what's coming next. Costs, of course, we've talked about that quite a bit, and that's really made a strong contribution to our sort of underlying performance in reducing our burn rate. And I think the combination of our top line growth, general productivity inside the business, increasing confidence around royalties, and the absolute cost reduction that we've managed is putting us in a very, very strong position to get to that cash flow break even. So very pleased.
Paul, as you mentioned, automotive royalties have started to increase again over the second half. Do you expect that to continue to grow during full year 2026?
Yes, we do. So as I think most people know, and as we've mentioned, we have the European General Safety Regulation kicking off in July 26. Also, Euro NCAP requirements, which are increasing each year. And what we're expecting to see from here until the end of July, and in fact beyond, is we expect that automotive royalty growth rate to accelerate. So we're now at a position where we're very confident. We have several new programs that will hit start of production, so that delivers increased volume into our plan. And then we also have the GSR opportunity that is pulling more volume through the OEM. So at this point, we are highly confident of an increasing growth rate in automotive royalties.
Martin, while you haven't split out the revenue by business unit, you reported that auto revenues include $10.2 million in royalty revenue, and that's related to guaranteed minimum volumes. Could you expand on that, please?
Yes, no worries. So we've talked about this previously. We have a number of program awards that are fairly unique in that they have a guarantee of a minimum volume of royalties over the life of the award. The amounts payable to us for the minimum royalties follows the planned production schedule, and we started to receive those payments during FY25. The first of those programs also started production in June. So based on the accounting standards, this triggers the recognition of revenue for the minimum amount for the whole program. And for the program that started production, this was $10.2 million. And so that amount has been recognized as revenue for FY25.
Martin, excess volumes included in adjusted EBITDA is more closely aligned with operational performance. This means that any volumes that relate to production vehicles but not under guarantee will be included in the adjusted EBITDA number. Is that correct? How does that ensure it's in line with performance?
Yeah, that is correct. And our adjusted EBITDA metric is one that we use as a proxy for cash flow and also to represent operating performance. The main element that we adjust for is to expense capitalized R&D. And we also exclude a few one-off items, one of which this year has included termination costs for the headcount reductions that we made during the year. With the revenue that we recognise for the minimum volume agreements, we've excluded that component from adjusted EBITDA, as it doesn't really reflect the performance of the current period or provide an indication of cash flow. So instead, we've included the amounts that are due to us on the payment schedule that relate for FY25, and that amount for this year was $700,000. In the future, as we go through the rest of the program and volumes increase above that minimum amount, we'll also start to include that revenue, both in the top line revenue number and in the adjusted EBITDA number.
Martin, can you give us a quick view of what to expect in full year 26 regarding these guaranteed revenues?
Yeah, so as I mentioned, we do have some other programs which include the minimum volume guarantee. The minimum amount for those three remaining programs is $43 million in total, and they're all currently scheduled to go into production during FY26. And so they'll be recognized as revenue in that year under the same accounting standard. The amount that we'll include in adjusted EBITDA will just follow the payment profile for the programs in FY26, and that'll be $800,000 for the first half, but then $5.3 million for the second half. And that skew really demonstrates the impact that we expect to see across auto programs as we get closer to the GSR deadline of July 2026.
Paul, you're already well into the first quarter. How's that full year 2026 shaping up so far?
Well, I think we're in for a very solid year. As I said a moment ago, our level of confidence around the accelerating growth rate in royalties is now pretty well set. So what that means is that we will see an acceleration in the, or I should say, more quickly reducing the monthly burn rate between now and December. And then beyond that, we will expect to see royalties grow at an even faster clip than the last quarter. So this is really positive. Our Guardian products, by the end of this calendar year, we will be producing and expecting to sell full production capacity at that point of between 6,000 and 6,500 units per quarter. So that's pretty strong. And then I should say that with the relationship that we built with Mitsubishi, it is now very evident that the growth prospects, not just in our aftermarket and automotive business, but in a whole range of vertical markets where Mitsubishi Electric Co. are very strong, we're beginning to explore in some detail the business cases for moving more rapidly into these adjacent markets. So I think that augurs well for not just our performance in this fiscal year, but the momentum that we'll build this year that will carry forward into 27.
James, I hope you'll continue to keep us updated with your progress. Thank you very much for speaking with us today.
Thank you very much.
Thanks, Stephen.
That's Seeing Machines CEO Paul McGlone and CFO Martin Ive.